Another way that the partnership interest may change is in the case of a sale of a partnership interest. Usually, when a partner sells their partnership interest, it's a capital gain or loss because the partnership interest is usually a capital asset to the partner. Section 751 would require ordinary income or loss on the sale or exchange of partnership interest for hot assets, just like we've been talking about this entire chapter. So if you have Section 751 assets, first, all unrealized receivables and inventory are 751 assets, not just substantially appreciated. And first, you'd have a hypothetical sale of assets for their fair market value immediately prior to the partner's sale of his or her interest in the partnership. The partner would be allocated his or her share of ordinary income or loss attributable to Section 751 assets. Next, we determine the gain or loss on the sale, that should say sale, or exchange of the partnership interest. And then in step 2, we determine the ordinary gain or loss component in any unrecaptured 1250 gain component and make that portion of the income ordinary. And then in step 3, the rest would be the capital gain component. And we would calculate that by calculating the residual gain or loss after assigning the ordinary gain or loss and the unrecaptured 1250 components. So it's basically just what's left over. Any liabilities of the partnership relieved when an interest is sold, and we treat that as money paid. So that includes money plus the fair market value of non-cash property received plus the seller's share of liabilities assumed or acquired by the purchaser. A partner may also retire or die. If a partner retires, they can sell their interest to an outsider or to the existing partners, and then a successor in interest may be bought out by the partnership itself. So say the partner passes away and a family member inherits the partner's interest in the partnership. Often the successor in interest, the person who inherited the asset, the interest in the partnership, may be bought out by the partnership. So in that case, the partner is going to receive payments. And payments for partnership property are generally taxed under liquidating distribution rules, and the partnership gets no deduction for those payments. But if there are other payments in addition to payments for partnership property, they're going to have different tax consequences. So these other payments are payments that exceed the value of the partner's share of partnership property, so the partner's basis. If those payments are made for unrealized receivables or goodwill of a service business, they're treated as other payments. Other payments can be of one of two types. They can be a distributive share or they can be a guaranteed payment. A distributive share is a function of partnership income. So if it's calculated based on partnership income, say 10% of partnership income or something like that, that's a distributive share. The distributive share flows through the partner, and then the other partners are also going to be taxed on a smaller amount of income. But anything else is going to be treated as a guaranteed payment, anything not made with regard to partnership income. And if a retiring partner receives a guaranteed payment, the partner recognizes ordinary income and the partnership is allowed a deduction. If Section 751 assets are involved in the retirement or death of a partner, we analyze those first, and you treat them for tax purposes just like you would under liquidating distribution rules. After you deal with the Section 751 assets, you analyze the remainder of the transaction as indicated for retirement or death, so like we've been talking about in the last few slides. In problem 38, Suzanne retires from the BRS partnership when the basis of her 1/3 interest is $105,000, which includes her share of liabilities. At the time of her retirement, the partnership had the following assets. The partnership has $60,000 of liabilities when Suzanne retires. The partnership will pay Suzanne cash of $130,000 to retire her partnership interest. A, what are the amount and character of the gain or loss Suzanne must recognize? So she is receiving a cash payment of $130,000. She is also receiving a reduction of liabilities because she's not liable for them anymore after she retires. And we also notice her basis in the partnership is $105,000. So in part A here, we see she's going to have a $30,000 capital gain and a $15,000 ordinary gain. We get this by looking at her share of the partnership assets, which she's a 1/3 partner, So we have the fair market value of the partnership assets at a total of $405,000. So her share is $135,000. So $135,000 of the $150 she receives is a payment, a Section 736B payment, which means that portion of gain will be capital gain. And you can see she received $150,000 of value because she received the cash, and then she also received a $20,000 release from the liabilities, which is a third of the $60,000 of liabilities. The gain is capital if she had the partnership as a capital asset, and then the remaining $15,000 payment doesn't represent payment for property. So it's something else, right? It's another payment. So it can either be a distributive share or a guaranteed payment. But it's not based on partnership income, so it's got to be a guaranteed payment. And the guaranteed payment is treated as ordinary income to Suzanne and a deduction to the partnership. So she has $30,000 of capital gain and $15,000 of ordinary income. All right, now part B. What's the impact of the retirement on the partnership and the remaining partners? She will no longer have a capital account because she's not a partner. The partnership will get no deduction for these payments, but it does get a deduction for the guaranteed payment. And then the remaining partner's basis in the partnership is increased to reflect the additional amount of liability each is allocated when Suzanne is no longer a partner. Because they didn't pay off the liability, they still have it. It's just not Suzanne's obligation anymore. We can also exchange partnership interest. And we might want to do that to get an interest in another partnership or a different interest in the same partnership. Section 351 is going to allow a partnership interest to be exchanged for a corporate stock interest in a tax-free transaction because partnership interests are treated as property. So if we want to form a corporation and exchange our partnership interest for stock, that's allowed, and it will be tax-free. The basis in the stock would be determined by the basis in the partnership interest, so it would be essentially a transferred basis. The holding period would include the holding period of the partnership interest, and the corporation would now be a partner of the partnership. The partnership may want to incorporate, which is tax-free under Section 351. They could do this in one of three ways. The partnership could contribute assets and liabilities to a corporation in exchange for stock and then distribute that stock to its partners and then liquidate the partnership. The partnership could liquidate by distributing its assets to the partners, and the partners could then contribute property to the new corporation in return for stock. And the partners could contribute partnership interest directly to the new corporation in exchange for stock, and then the partnership could liquidate. And as you can imagine, each of these situations will have different tax consequences. So the best choice is going to depend really on the tax attributes of each partnership and each partner. The partnership may also want to form an LLC, LLP, or LLLP. The conversion is viewed as a partnership to partnership transfer, so there's not going to be gain or loss on that generally. There's no termination of the tax year for the partnership, and there's no change in basis, assuming there's no change in liability allocations. If the partnership is terminated, then all of the distributions would be treated as a liquidating distribution. A partnership might be terminated or will be terminated if there's no business operated as a partnership. So either these assets are just being held and they're not operating a business, or one partner leaves and there's only one person left, so that can't be a partnership. A partnership has to be two or more people to conduct a business. If we have termination, it's going to result in a short period partnership return and a deemed pro rata liquidation to the partners. Section 754 is going to allow us to make a basis adjustment where the inside basis and the outside basis for an entering partner will be made the same. So Section 754 is going to allow the partnership to elect to adjust a new partner's share of basis in the partnership assets to equal his or her share in the partnership interest. So this is going to come into play when we have a new partner. So we have an existing partnership, and when the partnership was formed, everyone probably had the same basis. And in this case, let's say assets have dramatically increased in value, but the basis of our partners hasn't increased. However, if one partner wants to sell his or her partnership interest to a new partner, they want to get out and they want to sell, that new partner is going to pay based on the fair market value to be a partner. They're not going to pay based on the leaving partner's basis. They're going to pay based on the leaving partner's share of the asset, so the fair market value. And so in that case, they're going to step into the shoes of the leaving partner. So they're just going to take over that partner's share of basis of the inside basis of the asset. So the inside basis and the outside basis for that partner will not be the same. So it's accomplished by making a special basis adjustment equal to the difference between the transferee partner's basis in the partnership interest and the transferee partner's share of basis of partnership assets. And the basis only affects the transferee partner. And this is an optional election. The only time it would be mandatory is down here in the second section, and it would be required if the partnership has a substantial built-in loss, which means either the partnership's adjusted basis in total property exceeds the fair market value by more than $250,000, or the transferee partner would be allocated a loss of more than $250,000 if the partnership were to sell its assets for fair market value immediately after the transfer. When that election has been made and the partnership distributes property to the partner, the partnership makes the following adjustments. It increases the basis of partnership property by any gain recognized by the distributee partner on the distribution, and the amount by which the distributee partner decreases the basis of property received in a property distribution from the basis of the property in the partnership's hands. It would decrease the basis of the partnership property by any loss recognized by the distributee partner on a liquidating distribution, and the amount by which the distributee partner increases the basis of property received in a property distribution from the basis of the property in the partnership's hands. Okay, so let's look at an example to make this make more sense. Patty pays $100,000 cash for Stan's 1/3 interest in the STU partnership. The partnership has a Section 754 election in effect. Just before the sale of Stan's interest, Stu's balance sheet appears as follows. So you can see here that each partner's basis in the partnership is $80,000, Stan Traffic Corporation and Union Corporation. And you can also see that the fair market value of the assets is now $300,000. So when Patty wants to buy Stan's interest, Patty has to pay $100,000 because that's what this is worth. So when Patty buys Stan's interest for $100,000, Stan recognizes a $20,000 gain. But Patty, without a Section 754 election, Patty would take an inside basis in the partnership of $80,000. But she paid $100,000 for that interest. So her outside basis will be $100,000 and her inside basis would only be $80,000. And that can lead to some inequitable results. Okay, so that's why we would make this Section 754 election. And we would do it like this. It would be a $20,000 adjustment. And we would compare the purchase price minus Patty's share of partnership's basis in the assets. So the partnership's total inside basis is $240,000. Patty's share is 1/3 of that, so $80,000. So the optional basis adjustment is $20,000. And that applies just to Patty. So in Part B, if Stu Partnership sells the land for $220,000 immediately after Patty purchases her interest, how much gain or loss will the partnership recognize? Okay, so for book gain, the partnership has a basis in the land of $160,000 and they sell it for $220,000. So they have a $60,000 gain in the land. However, the partnership is only going to recognize a tax gain of $40,000 because of the $20,000 basis adjustment. So that $40,000 gain is going to be allocated to the two other partners, not Patty, because of this Section 754 election. See how much gain will Patty report as a result of the sale. So her share of the gain of the book gain is $20,000, but she recognizes none of this gain because of her $20,000 basis adjustment. And your book covers a lot of different flow-through entities, and I just want to briefly touch on LLCs because they're so popular. They combine the advantages of limited liability with the ability to conduct business as a flow-through entity, and now all 50 states have LLC statutes. It wasn't always like that. This is fairly recent, but now all 50 states have them. They have check the box regulations, which we've covered before. They allow the LLC to be taxed as a partnership or a corporation. With no election, though, an LLC with 2 or more members is treated as a partnership for tax purposes, and all of the provisions of the past 2 chapters we've been talking about apply to LLCs that are going to be taxed as a partnership. So it's a really great business vehicle for a lot of businesses. Some businesses still need to be corporations, but for a lot of businesses, the LLC is a really great form of business.